Ever wonder if you're truly making the most of today's stock market? Or maybe you're unsure if your current picks are the right ones for the long haul. Don't worry, we've all been there. But today we're breaking down where the real opportunities lie in this market shift.
I'm very concerned about two things. One is the debt buildup. In 2017, I think our national debt was $20 trillion. And 7 years later, it's $34 trillion. That's a growth rate far in excess of the growth rate of the economy. And that's going to be a problem one day. We don't know the day, but it's going to be a problem probably when we least expect it. And secondly, I would say, what's kept me involved in the market is if the 10-year bond belongs at 3.76 where it is currently, there's very little in the market that's overvalued, unless the 3.76 is reflective of a coming recession. And if it's 3.76x recession, there's very little that's overvalued.
So before we start, if you find value in this video, please support our channel by liking and subscribing to our weekly updates. The Fed just cut interest rates, and this could be a game changer for growth stocks. Lower rates mean cheaper capital for companies to expand and innovate. We're diving into 8 growth stocks set to thrive and one surprise pick that isn't a stock at all. Ready? Let's get started. Why do rate cuts matter for growth stocks? Simple. Lower interest rates mean cheaper borrowing, giving growth companies the fuel they need to expand and innovate. It's like a shot of adrenaline for the economy. When borrowing costs drop, companies can invest more and consumers are more likely to make big purchases, boosting overall activity. For growth stocks, this is the perfect environment. But keep an eye on metrics like the debt to equity ratio and forward PEE to spot potential. Now let's dive into the top growth stock set to soar in this low rate world. Stock 1, Caterpillar, ticker CAT. Caterpillar might not be the first company that comes to mind when thinking of growth stocks, but this industrial heavyweight is a sleeper hit. Caterpillar's stock has been on a tear recently, climbing to $355 per share, supported by a solid 32% gross profit margin. For investors looking to time their entries, keeping an eye on the moving averages, such as the 50-day and 200-day moving averages, is key. Stocks like Caterpillar that maintain levels above these moving averages typically indicate a solid uptrend. Caterpillar's price to earnings, PE ratio, sits at 15, with a forward PE of 13, making it relatively undervalued considering its growth potential. While revenue growth has been a modest 2%, the company is investing heavily in research and development, ramping up its R&D spending by 15% in recent years. This investment in innovation, particularly in autonomous and electric vehicles, positions Caterpillar for long-term growth. Additionally, checking Caterpillar's relative strength index, RSI, can be useful to spot overbought or oversold conditions. If the RSI crosses above 70, it might be worth waiting for a pullback. But before we proceed, here's a question. How do you think a potential rise in infrastructure spending could impact growth stocks like Caterpillar? Comment your thoughts below. Stock 2, Tesla, ticker TSLE. Tesla is one of those stocks that people either love or hate, but there's no denying its potential for growth. Tesla's gross profit margin of 17% is impressive, especially for a company in the capital-intensive auto industry. For a stock like Tesla, RSI and MACD are critical indicators to assess momentum. Checking the MACD will give insight into potential trend reversals, which is useful for a volatile stock like Tesla. Despite the high cost of manufacturing electric vehicles, Tesla's free cash flow margin remains solid, and the company is sitting on a $15 billion cash pile. Tesla's R&D spending is surging by 38%. Showcasing its drive to stay ahead. While revenue growth slowed to 8%, that's largely due to higher interest rates making car financing pricier. As rates drop, expect Tesla's sales to rebound with more affordable EV payments. Beyond cars, Tesla leads in renewable energy, robotics, and AI, offering massive future growth potential. However, with a forward PE of 63, the stock is already priced for heavy growth, which could signal caution for value investors. Stock 3, Nvidia, ticker NVDA. Nvidia is the undisputed king of graphics processing units, GPUs, and AI chips. The stock has soared from $40 to over $115 in the past year, driven by a massive 200% increase in revenue. Nvidia is an excellent example of a stock where growth and technical analysis converge. Using the 50-day moving average to track short-term trends, combined with long-term indicators like the 200-day moving average, will help you assess Nvidia's momentum. Nvidia's gross profit margin of 76% is extraordinary, and its cash flow margin of nearly 50% means the company is swimming in cash. What makes Nvidia particularly exciting is its position at the forefront of AI, autonomous vehicles, and data centers. Nvidia's products are in high demand across multiple sectors, and the company's R&D spending has increased by 35% this year alone. Given its rapid rise, be sure to monitor its RSI to ensure it's not in overbought territory. If the RSI crosses 70, it may signal a short-term pullback. Stock 4, Palantir Technologies, ticker PLTR. Palantir is a data analytics company that has recently gained traction in the market. Its stock has surged from $15 to $37, reflecting a growing appreciation for its potential. With an 81% gross profit margin and a free cash flow margin of 28%, Palantir is a highly efficient business with a solid value proposition. Palantir's high forward PE of 49 may suggest that the market is pricing in significant growth, but investors can use indicators like the PE ratio comparison to decide if the stock is overvalued or still has room to grow. Stock 5, PayPal, ticker PYPL. PayPal is a fintech veteran that continues to be a growth story. Despite some recent volatility, PayPal's gross profit margin of 40% and free cash flow margin of 21% make it a solid player in the fintech space. To determine the optimal entry point, the MACD indicator can help spot whether PayPal is experiencing a trend reversal, especially after periods of volatility. PayPal's revenue is growing at a steady 8 to 9%, and its forward PE of 16 makes it an attractive option for value-conscious investors. Stock 6, SoFi. SoFi is a fintech disruptor that is making waves in the personal finance space. With revenue growth of 30% and a gross profit margin of 82%, SoFi operates more like a tech company than a traditional bank. With its high revenue growth, monitoring RSI and MACD can help detect potential short-term corrections or trend continuations, and the company is just starting to turn a profit with a forward PE of 30, signaling that profitability is here. Stock 7, Visa, ticker FIV. Visa is the backbone of global payments, boasting a gross profit margin of 98%. For long-term investors, Visa's strong fundamentals make it less sensitive to short-term market fluctuations. Tracking its RSI can still provide opportunities for buying during brief pullbacks, especially in volatile markets. With a forward PE of 22 and steady revenue growth of 10%, Visa is a solid growth stock with a proven track record. Stock 8, iShares, Russell 2000 Growth ETF, IWO. Finally, we turn to an ETF that offers a way to invest in the collective success of America's small-cap growth companies. The iShares Russell 2000 Growth ETF, IWO, is a basket of over 1,000 small-cap companies, providing instant diversification. ETFs like IWO can be analyzed using broader market indicators, such as the overall small-cap index or sector performance. Tracking relative performance indicators like the ETF's Sharpe ratio can help determine risk-adjusted returns compared to other investment options. The table highlights key growth stocks, with Nvidia leading in revenue growth and a 75.98% gross margin. Caterpillar and Visa balance growth with income, offering dividend yields of 1.4% and 0.8%, respectively. Palantir and SoFi, though smaller, boast impressive gross margins of 81.39% and 60.93%. Tesla continues to innovate in the EV and tech space, driven by high R&D spending, and these stocks offer a range of opportunities, from high growth potential to stable dividends, catering to different risk profiles in a low interest rate environment. And that wraps up our list of the 8 best growth stocks to watch in this low interest rate environment. Before we wrap up, here's something to consider. With interest rates dropping, which sector do you think will benefit the most in the stock market? Let us know in the comments below. Remember, rate cuts take time to impact the economy, but stock valuations move quickly. Whether you're eyeing industrials, tech, or small caps, these picks offer great opportunities. Thanks for watching Simple Investing Secrets. If this helped, hit like and subscribe for more stock tips. Remember, this video is for informational purposes only and does not constitute financial advice. Always do your own research and consult with a financial advisor before making investment decisions. See you in the next video.